Hello viewers, welcome to my channel. I am Hasham Ali Khan. So in this video, I am going to continue the discussion on capital gain. Last three videos, I have explained you complete detail regarding how to compute the income from capital gain. What are the provisions under Companies in Income Tax Act 1961? I have explained you about transfer of asset and what do you mean by capital asset, and what is cost of acquisition, indexed cost of acquisition. All the points I have explained in the last three videos. Now in this video I am going to explain you about cost of improvement. Then summary points regarding calculating the indexed cost of acquisition. Next, assets acquired under special mode of transfer, and then components for calculating capital gain. What is the format for calculating income from capital gain? And lastly, short-term capital gain and depreciable, transfer of depreciable assets. So these are the points I'm going to cover up in this video. So if you watch this video, definitely the problem will be simple. Otherwise, the problem will be difficult. So watch the video till the end. Take a screenshot of the points which I've written on the board. Then I'll explain all the points in detail. Come on. First of all, the cost of improvement. See, while calculating income from capital gain, first of all, from consideration received, we deduct the transfer expenses. Net consideration we get. From consideration, we deduct the indexed cost of acquisition and indexed cost of improvement, if any. If it is there, then only we'll take indexed cost of improvement. Otherwise, we'll have indexed cost of acquisition only. So what do you mean by indexed cost of improvement? It means expenditure of capital nature in making any addition or alteration to the existing capital asset. SSC is already having a capital asset. In that capital asset, the SSC is making some additions, some alterations. And these additions and alteration are in the nature of capital expenditure. In the nature of capital expenditure. Example, a building is there. The SSC is owning the building. Now during a particular year, the SSC has added one more floor or some more rooms are added. The expenditure incurred in constructing additional rooms or expenditure incurred in making one more floor on the house property, that is called cost of improvement. So example, expenses incurred adding one or more rooms to the existing structure of building. Existing structure of building, adding one or more rooms, that is an improvement, cost of improvement. Expenses incurred by the SSC or previous owner before 1/4/2001 is to be ignored completely, because Income Tax Act says an SSC who purchases the asset before 1/4/2001. In that case, he has to take either the actual cost or FMV, whichever is higher. Fair market value on 1/4/2001. Whichever is higher, that will be taken. For example, if an SSC has purchased a house property in 1985, then after purchasing the house, after a few years in 1990, he has added one more floor to the house. So whatever expenditure incurred in acquiring the property, in improving the property, that will be ignored, because this was incurred before 1/4/2001. So if the SSC has purchased the property or incurred improvement expenditure before 1/4/2001, ignore it. We take only FMV on 1/4/2001. These are the provisions, cost of. Now summary points for calculating indexed cost of acquisition. In the last video, I have explained you indexed cost of acquisition meaning increased cost of acquisition or inflated cost of acquisition, because the value of money is not same. The value of money is declining. That's why, to give the benefit for this inflation, the Income Tax Act has allowed the SSC to make indexed cost of acquisition. But indexed cost of acquisition will be applied only for long-term capital gain. For short-term capital gain, indexing is not allowed. Apart from that, what are the other points regarding indexation? For all long-term assets, except debentures and bonds, indexed cost of acquisition and indexed cost of improvement are to be calculated. First point, all long-term capital assets except two, that is debentures and bonds. Leaving these two, all other long-term capital assets should be calculated indexed cost of acquisition or indexed cost of improvement. Second, for debentures and bonds, even if they are long-term capital assets, indexed cost of acquisition shall not be calculated. So Income Tax Act specifically given the provision, if the assessee has sold debentures or bonds, even if it is a long-term capital asset, indexing not allowed for debentures and bonds. Next one is, in case of capital indexed bonds issued by the central government, if they are long-term capital asset, their indexed cost of acquisition is to be calculated. Exception is there. Normally, all debentures and bonds, indexing is not allowed. But if these bonds are issued by the government as a indexed, capital indexed bond, so for capital indexed bonds, indexing is allowed. And this capital indexed bond will be issued only by the government. Next one, for short-term capital assets, indexed cost of acquisition is not at all calculated. Only for long-term capital asset, indexed cost of acquisition. Short-term capital asset not allowed. If the assessee are used, if the assets are used by the assessee in the business, which are subject to depreciation, even if the period of holding is more than 3 years, then the gain on transfer of such assets will always be treated as short-term capital gain. For such assets, indexed cost of acquisition shall not be calculated. Very important point, in problems we'll come across this point. If an assessee is holding an asset, which is a depreciable asset used in the business. So three conditions. First of all, the assessee is holding the asset. Secondly, the asset is a depreciable asset. Third one, the asset is used in the business. If these conditions are satisfied and the asset is sold during the year, then the gain arising on the sale of that asset will be a short-term capital gain irrespective of the period of holding. Whether the asset is held for 3 years, 2 years, 10 years, irrespective of the period of holding, it would be treated as a short-term capital gain and indexing is not allowed. Which type of asset? An asset which is used in the business and depreciable asset. Depreciable assets are building, machinery, furniture. Building, machinery, furniture. These are called depreciable assets on which Income Tax Act allows depreciation. Next one, short-term capital gain. How to compute short-term capital gain? Sale price minus transfer expenses minus book value or written down value. WDV stands for written down value. So in this way, short-term capital gain is calculated. Now, assets acquired under special mode of transfer. Normally, when an asset is purchased, we pay some consideration. For example, I have purchased one building. So I have paid the consideration and got the building. But sometimes an assessee will get to the asset in a special mode. That means without paying. Without making the payment, the assessee has got the capital asset. That is called assets transferred by special mode. So what are the circumstances in which assets will be transferred under special mode? I'll explain. If the assessee has acquired any asset under special mode of transfer, then the cost of acquisition will be the cost to the previous owner. If a person has acquired the property by special mode, by special mode means without paying anything. In that case, Income Tax Act says whatever is the cost to the previous owner, the same is the cost to the present owner. Example, if a person has transferred a building to his son, gifted the building to in the name of his son. Now, a son has not paid anything to the father. Father has gifted the property to son. It's a special mode of transfer. Income Tax Act says if son sells the property, then the cost of acquisition is the cost to the previous owner. Previous owner was father. So whatever is the cost of acquisition to the father, that is the cost of acquisition to the son. Now, special mode of transfer. When a transfer is said to be special mode, first, distribution of assets to members of HUF on partition. Suppose a Hindu undivided family was partitioned, was dissolved. The assets are distributed to the members of HUF. So without paying anything, the members of HUF are getting the share of assets. Special mode. Secondly, gifted properties. Any property which is gifted, no consideration. In that case, whatever is the cost of acquisition to the donor is the cost of acquisition to the donee. Next, properties acquired out of will. Suppose a person before dying, he has written a will that after his death the property will be transferred to so and so person. So on his death the property will be transferred without paying anything. Then whatever property the person gets, the cost of acquisition is the cost to the previous owner. Next, inherited properties. When a person dies, the property will be inherited to his family members, legal representatives. Then legal representatives getting the property through inherited property inheritance. That is also a special mode of transfer. Distribution of assets on the dissolution of firm. A partnership firm was dissolved. At the time of dissolution, assets are distributed to the partners. Again, it's a special mode of transfer. So in examination, a theory question may be asked, what are the cases of special mode of transfer? So you have to write down this one. That means special mode of transfer is that mode in which without paying anything, the person got the property. So whatever the cost to the previous owner is the cost to the present owner. Now, components for calculating capital gain. For computing capital gain, what are the factors we require? Requirement. So we need consideration received. Consideration received means sale price. Transfer expenses. Normally when we sell the assets, we have to pay some transfer expenses like brokerage, commission, etc. That next, cost of acquisition. At what price the assessee has purchased the asset? The purchase price is cost of acquisition and sale price is the consideration received. Cost of improvement. If there is any improvement will not be there in every case. In some problems, cost of improvement will arise. Otherwise, three items are compulsory. Consideration received, transfer expenses and cost of acquisition. Now, what is the format of computing the income from capital gain? This is the format. Computation of dash, income from capital gain for the assessment year dash. Now, consideration received we will take. From this consideration, transfer expenses we deduct. The net amount is net consideration. From net consideration, we deduct indexed cost of acquisition, indexed cost of improvement. Take the total of these. Take it in the outer column. Deduct. Net consideration minus this amount will get the capital gain. In the next video, I'll explain you the exemptions given under capital gain. On satisfying some conditions, Income Tax Act will give some exemptions under section 54, 54B, 54D, etc. So, if exemption is available, then exemption under section 54, exemption under section 54B, take the total outer column, deduct, will get income from long-term capital gain. Long-term capital gain. This is the format we are going to apply in the coming problems on capital gain. Now, short-term capital gain. An asset is treated as short-term capital asset when it is held by the assessee for not more than 3 years immediately preceding the date of transfer. So, the income tax on capital gain depends on whether it is long-term capital gain or short-term capital gain. The tax rate is different. So, short-term capital gain will arise when an asset is sold within 3 years from the date of purchase. From the date of purchase, within 3 years If the asset is sold, it is called short-term capital asset, right? And in case of debentures and security listed on stock exchange and units of UTI, the time period is 1 year. If the securities, if the shares, debentures, shares are traded in a recognized stock exchange and units of UTI, in that case, the holding period is 1 year. If these shares are sold within 1 year, it is called short term. If it is sold after 1 year, it is called long term capital gain. For unlisted shares, the time period is 2 years. So 3 years, 2 year, 1 year. Normal time period is 3 years. For shares and units of UTI which are traded in recognized stock exchange, it is 1 year. For unlisted shares, it is 2 years. In case of short-term capital gain, the purchase price of the asset is taken as cost of acquisition. We should never calculate indexed cost of acquisition for short-term capital gain. Simply, we take purchase price as the cost of acquisition. Purchase price will be the cost of acquisition, that is short-term capital gain. Lastly, transfer of depreciable asset. Just now I told you, if an SSC sells an asset which is used in the business and which is a depreciable asset, in that case, whatever be the period of holding, it will always be treated as short-term capital gain. Short-term capital gain. There is no long-term capital gain for depreciable assets. Provided condition, the asset must be used in the business and the asset should be a depreciable asset. Example, building, machinery, furniture. That's all. So in this video, I have explained you about the cost of improvement, then special points regarding calculating indexed cost of acquisition, special mode of transfer, what are the components of capital gain, short term, how to compute capital gain, format. Lastly, short-term capital gain and transfer of depreciable assets. Inshallah, we'll continue the next topic in the next video.